Hey everyone, welcome back. I hope you guys are having a great Sunday. So there's been a lot of talk on the web about Operation Choke Point 2.0. There's also a lot of FUD surrounding it, and I think there's some things we need to clear up with it. So a couple things we're going to look at. Things that have led up to this Operation Choke Point possibly taking place, and why that is important to look into it, as well as it is what the government has been doing lately to basically put a chokehold on the banking system and crypto in general, okay? So we're going to take a look at that. So we're going to take a look at here is, let me see here. So this is going to be kind of long also. This is going to be a deep dive. We're going to go through Nic Carter's blog on the Operation Choke Point as well. So it's going to be kind of long, so bear with me on this one. A lot to go through. Okay, first of all, things I want you guys to pay attention to here is what happened or what transpired in 2022. We had a lot of bankruptcies happen in that year. This was all pretty much early on in the year. We had Celsius Network. We had Three Arrows Capital with everything that happened with that, along with Terra Luna. You had Voyager Digital, and then obviously at the end of the year, you had FTX as well. BlockFi is in there as well. So we had a lot of crypto firms, companies, whatever they might be, hedge funds, go belly up because of, well, the market in general just went down in 2022, right? We peaked in 2021 in November with Bitcoin, and then pretty much the full year of 2022, crypto was going down. People got, I think, also prior to 2022, investors, companies got a little, what's what I'm looking for here? They got a little overzealous with the amount of money that they were making, and they were just leveraging to the brink here. Coins were being borrowed from one business to another business, and then those were being lent out to somebody else, and that was being lent out to somebody else. It was just crazy. It was way out of control is what I'm trying to say. And I think this is based on everything that's happened on the bankruptcies. We are basically now seeing the fruit of all that has transpired with the government and the FTEC, while DOJ, everybody else is cracking down on banks and anything else as they want to protect the banking system right now. Okay, so keep this in mind. Had this not happened in 2022, would we be having these Operation Choke Point 2.0 right now, as they're calling it, okay? So keep that in mind. So here's the blog post from Nic Carter. Operation Choke Point 2.0 is underway, and crypto is in the crosshairs. And like I said, why is it in the crosshairs? Was crypto an angel in the past year in 2022? No, it wasn't. We had a lot of stuff that went wrong, stuff that went bad. People lost a lot of money. And now it's basically everybody's trying to figure out how to protect the institutions that are in play in here, whether it's the banks or anything else. I think this is why we're seeing it. So this is just my take on it. So we'll go through his complete blog post here. We'll look at some of the sources that he also cites, and we'll look at some of the stories there, and I'll try to explain it as well. Okay. So here we go. What began as a trickle is now a flood. The U.S. government is using the banking sector to organize a sophisticated, widespread crackdown against the crypto industry, and the administration's efforts are no secret. They're expressed plainly in memos, regulatory guidance, and blog posts. However, the breadth of this plan, spanning virtually every financial regulator, as well as its highly coordinated nature, has even the most steely-eyed crypto veterans nervous that crypto business might end up completely unbanked. Stablecoins may be stranded and unable to manage flows in and out of crypto, and exchanges might be shut off from the banking system entirely. Let's dig in. For crypto firms, obtaining access to the onshore banking system has always been a challenge. Even today, crypto startups struggle mightily to get banks, and only a handful of boutiques serve them. This is why stablecoins like Tether found popularity early on, to facilitate fiat settlement where the rails of the traditional banking were unavailable. However, in recent weeks, the intensity of efforts to ring-fence the entire crypto space and isolate it from the traditional banking system have ratcheted up significantly. And we can definitely see that what's going on here. Specifically, the Biden administration is now executing what appears to be a coordinated plan that spans multiple agencies to discourage banks from dealing with crypto firms. It applies to both traditional banks who would serve crypto clients and crypto-first firms aiming to get bank charters. It includes the administration itself, the influential members of Congress, the Fed, the FDIC, the OCC, and the DOJ. Here's a recap of notable events concerning banks and the policy establishments in recent weeks. So let's go through these here. On December 6th, Senator Elizabeth Warren, John Kennedy, and Roger Marshall sent a letter to crypto-friendly bank Silvergate, scolding them for providing services to FTX and Alameda Research, and lambasting them for failing to report suspicious activities associated with those clients. We know that there was a lot of junk crap going on with FTX and Alameda, where they were, using customers' deposits and automated research funds, and it was just a mess. With Senator Elizabeth Warren and everybody else, we know that she likes PR. This was a PR more than anything else. There were some concerns. Obviously, yes, there are concerns with what happened there. But as far as how Silvergate Bank would have known what's going on there, that's highly unlikely. They were dealing with a customer that was basically transferring funds from one account to another. Even if they were not possibly even doing that, the accounts were there. It was just a mess, and I don't think that has anything to do with it. But that is, he's pointing this out as a possible thing that's a coordinated effort to, do this kind of operation. Next, on December 7th, Signature, among the most active banks serving crypto clients, announces its intent to have deposits ascribed to crypto clients. In other words, they'll give customers their money back, then shut down their accounts, drawing its crypto deposits down from 23 billion at peak to 10 billion and to exit its stablecoin business. So let's take a look at this one here. This was kind of interesting, I thought, and we'll get through this right here. So Signature Bank to reduce crypto exposure by 8 to 10 billion. After achieving significant growth from accepting crypto deposits, Signature Bank, SBNY, recently announced at an industry conference that it would reduce deposits tied to cryptocurrencies by 8 billion to 10 billion. The move comes in light of falling token prices and the FTX-inflicted turmoil in the cryptocurrency market, which has also resulted in significant price volatility for SBNY. As of November 14th, 2022, Signature Bank deposits balances in the digital asset space amounted to 23.5 billion, or roughly 24% of total deposits. That's a lot. That's 24%. That's a quarter of all the deposits are tied to crypto somehow. The company previously noted that it only has a deposit relationship with FTX. The crypto's exchange deposits made less than 0.1% of the company's overall deposits. So that was a positive there. That was good. But here's the interesting part. Signature Bank is one of the only federally regulated U.S. bank known to accept large-scale crypto deposits and crypto exchanges, stablecoin issuers, and Bitcoin miners as customers. These helped the bank scale its deposits in the past. However, the crypto values erosion from November 2021 highs, the recent liquidity crunch, and the FTX bankruptcies have contributed to weakened investor confidence in the digital asset space. Shares of the company have plunged 63.3% of the year, underperforming the industry's loss of 17.3%. Two things to take away from this one is, really quick, the amount of loss that they lost, more or less, are being kind of tracked with Bitcoin and the crypto space in general. With the share price coming down 63%, they are more or less following crypto, right? So that's a concern not only for the bank, but also for the bank board, things like that. They don't want to be really associated with something like that when falling, when you see other banks only down 17%. The other thing was, obviously, the exposure that they did have was pretty high, 24%. That's pretty high of a bank's deposits. So no wonder that they wanted to get out of it. Next, hence the bank's move to eventually reduce digital asset-related deposits exposure to less than 15% and exit stablecoins as a business will help shift investors' focus from its crypto-related business. Also, SBNY plans to cover the aggressive reduction in deposits by reducing cash and increasing borrowings. Right, so they're trying to deleverage themselves a little bit of this crypto space, because what we've seen in the year happened in 2022. Crypto prices went falling. Their stock went falling because of it, because they're so tightly inwoven with crypto, 24% of their deposits, that has taken a big hit on them. So, like I'm saying, this is not really based on regulators forcing them to do it. It's more about themselves wanting to do it here, okay? Next, continue on here. On January 3rd, the Fed, the FDIC, and the OCC released a joint statement on the risks to banks engaging with crypto, not explicitly banning banks' ability to hold crypto or deal with crypto clients, but strongly discouraging them from doing so on a safety and soundness basis. Well, after what we've seen happen in 2022, do you wonder why they're doing this? Right, they want to make sure that the banks that are FDIC insured are solvent, that they are protected, that there is trust in the banking system. If you lose trust in the banking system, you're going to have a run on all the banks. So I'm not surprised that they're doing this. Okay. Next, on January 9th, Metropolitan Commercial Bank, one of the few banks that serve crypto clients, announces a total shutdown of its crypto assets related vertical. Let's take a look at that one here really quick. Today announced that it fully exited the crypto asset related vertical. The decision follows a careful review by the board of directors and management and reflects the recent developments in the crypto assets industry, material changes in the regulatory environment regarding banks' involvement in crypto assets related businesses, and a strategic assessment of the business case for MCB's further involvement at this time. The company expects financial impact from the exit of this vertical. MCB currently has 4 active institutional crypto asset-related clients that in aggregate currently account for approximately 1.5% of total revenues and 6% of total deposits. So those deposits are pretty low there. Let's see, there was something else here. There it is. Today's announcement of our exit from the cryptocurrency-related asset vertical represents the culmination of a process that began in 2017, Remember, 2017 was the peak of the previous bull cycle for Bitcoin when we peaked in December at around 19,000 something. After that, we had that bear market for the next couple of years, which wasn't great. And so they have experience in this as well. When we decided to pivot away from crypto and not grow that business, said Mark D. DeFazio, president and CEO of MCB, crypto-related clients' assets and deposits have never represented a material portion of the company's business and have never exposed the company to material financial risks. We remain focused on growing our core business and delivering superior value for our stakeholders through the high-touch relationship-driven banking, supporting by financial discipline and sound risk management. So they have basically, from 2017, started to pivot away from this as well, right? This is what they're doing to make sure that their bank is sound right now. Next, Metropolitan Bank on January 9th, Silvergate stock falls to a low of $11.55 on bank run and insolvency fears, having traded as high as $160 in March 2022. Well, now we know that Silvergate has actually went belly up. They went bankrupt. They are divesting themselves of all the assets and trying to make everybody whole that had deposits with them. And that was partially because of FTX potentially. And then on January 29th, Binance announces that due to policy at Signature Bank, they will only process user fiat transactions worth more than 100,000. So this was from Signature Bank, and let's see if I have this here. Binance Signature Bank. Yep. Well, this is actually paywalled, so I can't see this. You guys can take a look at it if you guys have access to this one. But I wanted to talk about that one, but I can't. And then on January 27th, the Federal Reserve denies crypto bank Custodia 2-year application to become a member of the Federal Reserve System, citing safety and soundness risk. Let's take a look at this one. This one I do have. So Federal Reserve Board announces denial of application by Custodia Bank, Inc. to become a member of the Federal Reserve System. The Federal Reserve System Board on Friday announced its denial of the application by Custodia Bank, Inc., Cheyenne, Wyoming, to become a member of the Federal Reserve System. The board has concluded that the firm's application as submitted is inconsistent with the required factors under the law. Custodia is a special purpose depository institution chartered by the state of Wyoming, which does not have federal deposit insurance. The firm proposed to engage in novel and untested crypto activities that included issuing a crypto asset on open, public, and/or decentralized networks. So here's the main takeaway from this. They are FDIC uninsured right now, and the firm is creating basically something new that has never been tested in the banking system right now, and novel and untested crypto activities that include crypto assets on the open, so in the blockchain basically right now. Not sure what they're trying to do there, whether it's use stable coins or anything like that for transacting between other banks or whatever that might be. The firm's novel business model and proposed focus on crypto assets presented significant safety and soundness risk. Well, can you blame them after what happened in 2022 with all the bankruptcies and now what we've seen with Silicon Valley Bank and then the other one as well? So I'm not surprised by this at all. If they didn't have possibly the wording in there that they were trying to get into crypto or some kind of new novel way of working with crypto, maybe they could have passed this and gotten it through, but they're obviously trying to do something different here. Next, let's continue on here. On January 27th, the Kansas City Fed branch denies Custodia's application for a master account, which would have given its ability to use wholesale payment services and to hold reserves with the Fed directly. And this could be going back to their novel crypto use that they were trying to get to. On January 27th, the Fed also issues a policy statement which discourages banks from holding crypto assets or issuing stablecoins and broadens their authority to cover non-FDIC insured state charter banks. A reaction to Wyoming Special Purpose Depository Insurance, SPDIs like Custodia, which can hold crypto alongside fiat for its banking customers, right? There's a concern again. You're going to be holding crypto, which can fluctuate tremendously from the highs to the lows and anywhere in between. With the banking system, they're really worried about having that be as stable as possible and as trusted as possible as it can be. They want nothing less than to have people all over the United States doing a bank run on their banks, right? That's going to be a whole economic collapse. So I can see why they are afraid of that. On January 27th, the National Economic Council releases a policy statement not explicitly banning banks from serving crypto clients, but strongly discouraging banks from transacting with crypto assets directly or maintaining exposure to crypto depositors. I think I have this one here. This one actually links to the White House statement here, which is, the administration's roadmap to mitigate cryptocurrency risks. So this is kind of what they're doing, why they're doing it. You guys can take a read at it. I'm not going to go over it here. On February 2nd, the DOJ Fraud Unit announces an investigation into Silvergate over their dealings with FTX and Alameda. Well, you know what happened with the FTX and Alameda. They had funny books, a lot of stuff that went wrong. And this is just them trying to figure out what's going on and then was there any fraud involved in it. I don't think Silvergate had anything to do with fraud or anything like that. They were just basically the bank that the FTX and Alameda use, but we'll see what comes out of that investigation. On February 6th, Binance suspends USD bank transfers for retail clients. Binance US was not affected. And that one was, let me see if I have that one up here. If I pull that one up here really quick, if I don't have it. So crypto exchange Binance to suspend US dollar bank transfers this week. US bank transfers compromise only a tiny bit of monthly active users, the exchange said. So that wasn't too bad. Crypto exchange Binance is temporarily suspending US dollar bank transfers starting on Wednesday. The company confirmed to CoinDesk on Monday. We are temporarily suspending USD bank transfers as of February 8th, as a Binance spokesperson said, noting that 0.01% of monthly active users use USD bank transfers. So this is based on USD from outside, possibly, I'm guessing. The interim, all other methods of buying and selling crypto remain unaffected, including bank transfers using one of the other fiat currencies supported by Binance, including euros. Yeah, so this was more in line with their overseas operations. Then that one, on February 7th to January 27th, Fed statement is entered into the Federal Register, turning the policy statement into a final rule with no congressional review or public notice and comment period. So this, I agree, this is definitely the wrong way of going about it. There should always be congressional review or public notice and or comment period to let everybody have their say in this, and then the rules can get changed or whatever based on all the feedback. This is just kind of like throwing it in your face and saying deal with it. So I agree with this. You guys can take a look at that also. So I'll provide his article, link to it in the comments down below. You guys can take a look at all this and look at it that way as well. As of February 8th, Protego and Paxos application to follow Anchorage and obtain full approval to become national trust banks are still outstanding, past the 18 months deadline, and appear likely to be imminently denied by the OCC. Not sure what's going on there. Haven't followed up on that one. You guys can do that in yourselves. Okay, let's continue on here. So in the sum, banks taking deposits from crypto clients, issuing stable coins, engaging in crypto custody, or seeking to hold crypto as a principal have faced nothing short of an onslaught from regulators in the recent weeks. Right, this is in recent weeks. This isn't like in the past 1 year or year and a half. This all happened within the last couple of weeks where they're trying to catch up with everything that's happened with all the bankruptcies and everything else. So there's a cause and then an effect. The cause was the bankruptcies. This is the effect of what we're seeing now. Time and again, using the expression safety and soundness, they've made it clear that for a bank, touching public blockchains in any way is considered unacceptable or risky, while neither the Fed, FDIC, OCC statement nor the NEC statement a few weeks later explicitly ban from servicing crypto clients. The writing is on the wall, and investigations into Silvergate are a strong deterrent to any bank considering aligning itself with crypto. Now, that might be the case here. I would agree with that. So that is definitely going to be a strong deterrent for any bank thinking about getting into this. Do they want the hassle of it? And as long as I think they're, I have a bank where I bank with that I can pull fiat out, put it into an exchange, buy Bitcoin, whatever, I can put money back into it. That's not a problem. I haven't had a problem since 2017. So no issues there. Other banks might be a little bit more skittish. Smaller ones, especially some of the larger ones, might be also, but we'll see how that's going to play out. What is clear now is that issuing stablecoins or transacting on the public blockchain where they could circulate freely like cash is highly discouraged or effectively prohibited. Well, yeah, I mean, stablecoins is one thing. Stablecoins have to be pegged to the dollar or something like that. And that makes it a little bit more challenging for them to see what's going on there. And then also knowing your customer, fraud. Then you have also anti-terrorism laws that go into effect with all that. So it makes it a little bit more difficult. So I can see why that's happening. Okay. It is equally evident that a bank-issued fiat token would only be acceptable to regulators if it were domiciled on a surveilled private blockchain, right? That's kind of what we're talking about. You don't have access to that. Well, public blockchain, you have access to it, but you could actually see the transactions happening between places a lot faster. And no unhosted wallets allowed. And perhaps most damagingly, the Fed's devastating denial of Wyoming's SPDI Bank Custodia, as well as their policy statement, effectively ends in any hopes that a state-chartered crypto bank might get access to the Federal Reserve System without submitting to the FDIC oversight. Okay. Now, not sure what Custodia is doing as far as trying to get a crypto, whether they're going to be using it as they're looking to possibly have their own stable coin or something like that, something they can do between banks, payments, something like that. Not sure what's going on there, but if they can figure out or get that to work, possibly the FDIC might get it in approved. That's a big if. I don't know what's going on there. I'm not a bank expert, but this is kind of just my own interpretation into it. Continuing on here, why might crypto entrepreneurs be wary of the FDIC? It traces back to Operation Choke Point. Some in the crypto space believe that the recent attempts to ring fence the crypto industry and cut off its connectivity to the banking system are reminiscent of this little-known Obama-era program. So this goes back to 2013. Beginning in 2013, Choke Point was a scheme which sought to marginalize specific industries operating illegally, not through lawmaking, but by applying pressure via the banking sector The Obama DOJ had already cut its teeth with its successful effort to sideline the online poker space in 2011 and in 2012 with threats issued to banks supporting poker companies. With choke point, the department decided to scale up its efforts and target other industries, starting with the uncontroversial targets like payday lenders. Then the DOJ coordinated with the FDIC and OCC to pressure member banks to redline, determined as too risky to do business with certain legal but politically disfavored sectors, chief among them firearms manufacturers and adult entertainment. Banks and payment processors internalized this guidance, and even after the program was formally shuttered under Trump in 2017, its shadows lingered. Today, banks simply ascribe to a higher risk to activities that they suspect might draw the government's ire, even if no specific guidance exists. Okay, right? You get kind of slapped. You don't want to. You want to tread carefully, especially the banks do with the government, because you don't want to give them a reason to investigate and everything else. So you tread carefully there. I can see that happening. Since choke point nominally ended, using financial rails as an extrajudicial political cudgel has only become more popular. Under pressure, a number of banks walked away from the Dakota Access Pipeline in 2017. In 2018, Bank of America and Citigroup deplatformed firearms companies, and BOA began to report client firearm purchases to the federal government. In 2019, AOC announced her intent to marginalize private prisons through her seat on the House Financial Services Committee. Financial regulators are being asked to advance progressive causes too. In 2021, the Democratic House passed the Federal Reserve Racial and Economic Equity Act, which would have required the Fed to aim to eliminate disparities across racial and ethnic groups with respect to employment, income, wealth, and access to affordable credit. Gensler, CEO, now maintains a controversial climate agenda, as does the Fed at smaller scale. Kamala Harris has deputized banks to advance a racial equality agenda, effectively imposing uneven demographic standards for credit provisioning. This is all beyond me. I have no knowledge of all this stuff. I'm just reading here what he said. Today is even commonplace for explicitly conservative organizations like Gab or Parler and various malcontents and dissidents who fall afoul of regime politics to find themselves deplatformed from banks, fintech, and payment processors that they rely on to do business. For those who support this, I would invite you to imagine the financial inclusion or exclusion under a similarly zealous DeSantis administration might look like. Just build your own bank, right? Well, not if the Fed has anything to say about it. As evident with the stillborn Wyoming SPDI, the crypto industry tried that path and was utterly stymied. Yes, but again, the Wyoming thing with the bank there, they were trying to do their own thing with some kind of crypto, whether it was a stablecoin or whatnot, don't know. Banks are highly regulated public-private partnerships in an environment where new charters are excruciatingly hard to obtain, and as such remain de facto arms of the state. It has been and remains trivial to deputize them to carry out political objectives. If there was any doubt, it's now evident that the Obama administration and its successor in Biden's regime are comfortable circumventing the First Amendment by engaging normally private companies to do their dirty work. Anyone paying remote attention would have noticed the oddly close revolving door between monopolistic big tech firms and Obama-Biden security state officials. And ever since Elon Musk leaked the Twitter files, it's nakedly clear that the U.S. government and its security apparatus use proxies at Twitter for overt censorship and narrative control. Twitter is just a private company, though, right? Good question there. And then in 2017, Trump and Republican lawmakers like Representative Lutekmeyer were able to put a stop to choke point for a time, but didn't last. One of the first moves from Biden's OCC was to undo Brian Brooks' Fair Access Rule that prohibited political discrimination in banking. Biden's deputies picked up where Obama's regulators had left off, and now after the time it took to digest Biden's executive orders, regulators are tightening the screws. So that could very well be the case here. Obama and Biden were together at that time. This could be just like you're saying 2.0, but I think it's also a lot to do with what happened in 2022. Gotta remember that. Today, the outlook for banks remotely interested in crypto is precarious. Bankers tell me that crypto is toxic and the risk of engaging with the asset class aren't worth it. In the wake of the Custodia decision, obtaining a new charter for a bank looks extremely unlikely. Banking innovations at the state level, like Wyoming SPID for crypto banks, appear dead in the water. Federal charters for crypto firms with the OCC also look dead in the water. Traders, liquid funds, and businesses with crypto working capital are nervously examining their stablecoin portfolios and fiat access points, wondering if banks' connectivity might be severed with little notice. So that is definitely a concern here. We'll see how this is going to play out. I don't think, some of the big guys, you got Coinbase, you got Gemini, some of the big guys that have been around for a long time, I don't think they have anything to worry about. The new guys coming into the space might have a little bit more harder problem. So we'll see. Where do we leave off? With little notice, privately entrepreneurs and CEOs in crypto tell me that they sense a regulatory noose tightening. As crypto-facing banks de-risk, younger and smaller firms will struggle to get banking, taking us back to the 2014-2016 period when fiat access for crypto business was an extreme premium. Exchanges and other businesses that rely on fiat on-ramps and concerned that their few remaining bank partners will shut them off or institute draconian standards for scrutiny. As a venture capitalist operating at the early stage, I am directly witnessing the chilling effects of this policy in action. Founders are reckoning with the new uncertainties around whether they'll be able to operate their business at all. That is true. I'm sure that that's going on, but also why is it going on? Did we do something to deserve this? Like I keep saying, did we go back? There's always a cause and effect, and we kind of brought this on ourselves. Unfortunately, that's kind of what I'm seeing. So why push the bank regulators now? The FTX collapse and its ensuing effects, particularly on Silvergate, provides much of the answer. Financial regulators weren't interested in FTX while the fraud was underway, with the exception of the SEC and its chairman Gensler, who had oddly close ties to the organization. But ever since the exchange failed in spectacular fashion, they are now contemplating ways to avoid that next such collapse. Correct, right? They don't want to repeat that. The FTX as an offshore exchange was not directly supervised by the financial regulators aside from FTX US, which was a marginal stub. So it was outside of their direct aegis. However, regulators believe that they might have a silver bullet in the fiat on and off ramps on which the industry relies. If they can choke off fiat access, they can marginalize the industry on and offshore without regulating it directly. Yes, but then they would be basically shooting themselves in the foot if that happens, because like it or not, crypto, Bitcoin, whatever you want to use for that terminology, is going to continue on. Other countries will adopt it. They will make it much easier for industry to use it, things like that. And we should be leading as the United States, as we led with the internet back in the 1990s. We should be doing the same thing now with blockchain and crypto as it goes on. So that's something that's definitely got to be taken into consideration. In some key respects, Crypto Choke Point 2.0 differs from the original. It appears that the administration has learned from their efforts of its predecessors. In Choke Point 1.0, guidance was mainly informal and involved backdoor, off-the-record conversations. Its main tool was the threat of investigation from the DOJ and the FDIC if financial institutions didn't internalize the administration's risk standards. Because this was patently unconstitutional, it gave Republicans the collateral to ultimately repeal the program. In 2.0, everything is happening in plain sight in the form of rulemaking, written guidance, and blogs. The current crypto crackdown is being sold as safety and soundness issue for banks and not merely reputational risk issue. So this goes back to what happened before. Why is this happening now? Could this be part of it as well? I think it is. Jake Chervinsky of the Blockchain Association calls it regulation by blog post. No need to ask Congress for new laws. The federal regulators can simply make policy, and in the case of the Fed, grow their scope and mandate by publishing guidance which dissuades banks from doing business with crypto. COSIA's Caitlin Long calls the Fed denial of her application, shooting the stallion to scatter the herd, which could be the case. As a consequence, the only banks willing to touch crypto at this point are smaller, less risk-averse ones with more to gain from banking the industry. However, this means that crypto deposits and flows end up being substantial relative to their core business, which introduces concentration risk. Banks prefer not to have excessive exposure to single counterparties or a depository base that is highly correlated to its inflows. Right, going back to that other bank, which was the Bank of a Metropolitan. Not which one was it? Was it this one? Yeah, Metropolitan Commercial Bank. Right, they had 24% or something like that, or Signature Bank had 24%. Right, they definitely don't want to be in that boat. Let's see here. Survive the flows. Silvergate felt this accurately within the bank when it suffered and survived. It actually didn't survive. It just went belly up. Post FTX, while it's impressive that they were able to honor 70% drawdown in their depository base, that episode will dissuade any banks looking to serve crypto clients that might face the same. And that's true, right? But that's based on the things that have happened in the past. It doesn't just, for whatever reason, if everything was peachy and rosy and everything was great, there would be no need. I don't think this stuff would be going on right now that we're seeing. So cause and effect. And particularly speaking, labeling crypto-facing banks high risk has 4 direct effects. It gives them a higher premium with the FDIC. They face a lower cap rate with the Fed, which inhibits their ability to overdraw. They face restrictions on other business activities, and management risks a poor examination score with the regulatory supervisors, which inhibits their ability to do mergers and acquisitions. So while some analysts like Wilson S. Jess Chang have pointed out somewhat optimistically that banks are not explicitly barred from providing crypto custody or onboarding crypto clients, they still stand to get labeled high risk and face serious business hurdles as a result. So that is true as well. If anything, what might happen is anybody that's doing in crypto might get a little bit more, they're going to pay a little bit more of a premium, possibly. Might be the case. Okay, some might be sympathetic to regulators' attempts to insulate the banking system from the I can't pronounce that word. That's the word there, of crypto space. But thus far, crypto various disasters haven't produced any meaningful contagion. The industry had a full-blown credit crisis in 2022, with virtually every major lender going bankrupt, but the damage was contained. The worst fallout in the banking space was suffered by Silvergate, which suffered an $8 billion drawdown but survived. Now it didn't survive. We had Silvergate, now we had Silicon Valley Bank. So there is contagion here, and we'll see where that contagion goes. No onshore fiat-backed stablecoins suffered any meaningful adverse effects despite the massive crypto sell-off in 2021 and 2022. They functioned as intended. Well, fiat, okay, so they're not talking about Luna. Luna was backed by BTC. They functioned as intended, and no contagion spilled into traditional finance via mass selling of treasuries, something officials have historically felt might be a key transmission and channel. Now, that is kind of what's happening, I think, with Silicon Valley Bank, but we'll see what that actually comes out once all the news does come out on that one. So as Biden enters the second half of the term, his crackdown on crypto banking has deflated hopes for regulatory rapprochement. In the U.S., many crypto entrepreneurs now tell me that they're waiting for 2025 and a putative DeSantis regime for things to turn. Some can't wait long enough and are shuttering their plans for businesses which involve any type of regulatory approval, especially with regards to bank charters. Regulators are effectively picking winners with larger, more established crypto firms able to hang on to their bank relationships while newer ones are shut out. Meanwhile, other jurisdictions are making a bid for their business. Hong Kong has adopted a friendlier tone once again, and has the UK, the UAE, and the Saudis are looking to attract crypto firms as well. And U.S. regulators are can scarcely afford to forget what happened with FTX, in which they curtailed the business activities of onshore exchanges, effectively pushing U.S. individuals into waiting clause of Sam Bankman-Fried. If bank regulators continue their pressure campaign, they risk not only losing control of the crypto industry, but ironically increasing the risk, pushing activity to less sophisticated jurisdictions, less able to manage genuine risk that may emerge. I agree with that. That's completely true. The U.S. has to lead in this regard, I believe. But with all that being said, there's a lot in here. There's a lot going on. But I do, like I've said from the beginning, I'll say it now. I think it's cause and effect. This was caused by our own doing, by the stupidity of some of the people that were in charge of billions of dollars, unfortunately, with 3 R's Capital, Sam Bankman-Fried. They didn't have the proper controls in place to be able to do what they did. All right. If they had the controls in place and everything else, this wouldn't happen. It was basically kids in the playground. They were playing with people's money that they really shouldn't be playing with it. Okay. So that's just my take on it. We'll see how this is going to play out. If this gets worse, then yeah, this could definitely be a bigger story than it is right now. But like I said, I think this is truly just based on the crap that happened in 2022 with all the bankruptcies and everything else. Now that we're seeing it also with Silvergate, Silicon Valley Bank, it's all coming on us right now because the industry by itself could not regulate itself, and we effed up. So hopefully the industry itself has learned from this that we need to regulate ourselves a lot better than the U.S. government and provide insight in how we can go forward with it. But that's just my take. Let me know what you guys think of this. I think that this is getting a little overblown currently. This was on us, unfortunately. We have to fix it. Well, not me, but people that are working in this space, they have to fix it, unfortunately. Okay, so that's it. Hope you guys enjoyed it. Let me know what you guys think in the descriptions or in the comments down below. Hope you guys have a great Sunday. We'll see what happens with the banks happening, well, with Silicon Valley Bank deposits and everything else. Is somebody going to buy them out or not? And is there going to be a contagion going into next week and following week as well? Okay, so have a great day. I'll see you guys in the next one. Bye.